What do you make of futures under some pressure? We saw the markets, they finished like very fractionally higher yesterday, just by a scooch. But why do you think futures are under pressure this morning? We seem to have kind of shaken off that Moody's downgrade.
Well, I think we can shake off the Moody's downgrade, but there has been a bit of a valuation challenge that's been emerging for equities here. The recovery's been pretty fast and furious. I think there is a recognition that we'll see a little bit of economic drag from these tariffs in the quarters ahead. And you've got valuations at a pretty elevated level. So it's a decent time for a pause, kind of look through a bit, see how the back half of the year looks. And we seem to be around fair value now based on valuations, given where earnings are today and what we think in the quarters ahead.
All right, so Joanna, I think one of the questions for a lot of investors today is how do you view the bond market? Is today a buying opportunity when it comes to bonds, or do you see potential for yields to move even higher to the upside?
Yeah, so we see the bond market through the lens of income, and right now yields and also interest rates are at historical highs. So the income is a really powerful tool to offset all of this volatility in your portfolio. So when you look at this opportunity set in fixed income, you want to be making sure that your portfolio has enough income to offset this volatility. Volatility is here to stay. We've been through lots of bouts of it since 2020. We need to kind of move on and start using bonds more appropriately in a portfolio.
All right, so if we're using it appropriately, what's the right area when we're looking at bonds, specifically treasuries, to buy? Rick Reeder from BlackRock came out with a note yesterday saying that he likes the short end of the curve right now. He thinks that's very attractive. Do you agree with that idea, especially when we're hearing Fed officials say those cuts are being pushed further and further out?
Yeah, so I think the reason we are all recommending the short end of the curve is, like I said, rates are at historical highs. So you're getting, great yields around 4% on the short end of the curve. The 1 year, 6 month is a good place to be. In the 20-year, just year to date, has gone from negative to positive 20 times. So it tells you that it's reflecting all of this uncertainty in the economy, all this uncertainty that's going on. You don't want to play in the 10-year and the 20-year space. One of those turnovers was 7% in about a week in April. So that's the type of volatility you don't want in your portfolio. So that's why the short end of the curve, not only short end of treasuries, but you want shorter bond investments so you have low interest rate risk.
All right. By the way, we had a 3-month and a 6-month Treasury auction yesterday. I'm sure that yield looks pretty attractive to people. I think it's about 4.3% when you're looking at the 3 and the 6 month. Robert, I want to come over to you. So we know the White House is watching the yield on the 10-year very closely. The Treasury Secretary has told us that. How should investors view it? I want to play a soundbite from you, or for you, I should say, from Evercore's Julian Emanuel on the impact of the 10-year yield on the market.
If you go back to the beginning of this bull market in October of 2022, we broke it down. The vast majority, above 90% of the gains, are attributable to when the 10-year yield was below 4.5%.
All right, so with that in mind, important to know the 10-year yield is below 4.5% right now, but just a few basis points. How should you view the market with the potential for another spike in yields, with a lot of questions about the tax bill coming up, how bond investors are going to respond to that, and a number of other issues, inflation reports, et cetera?
Yeah, I do think 4.5 or a bit higher is potentially a ceiling in terms of where you push valuations on the equity side. But I think it's important to ask the question of why we're at 4.5 now. In my view, it's less a story of weakness and less a story about the downgrade and more a story of strength. The Fed communicated that they were going to be on hold indefinitely at 4.5%, mainly on the basis of the economy remaining very strong. First quarter earnings were better than expected. Consumer spending remains strong into May. Payroll gains have continued. There have been very little layoffs. And on the equity front, there's a lot of optimism, I think, that's well placed around the potential for margin gains, even in a slower growth economy. So I think the 4.5% yield is actually indicating some strength here in the economy rather than a weakness on the basis of the downgrade that occurred the other day.
All right, so if you think it's showing strength in the economy, so that means that even if we see that yield approach 4.5%, are you still a buyer of equities?
Yes, absolutely. I mean, our work shows that you can go above 4.5%, even up to closer to 5% before you have some big valuation problems. That said, I don't think the market is cheap here. We think the path forward is through earnings. The second quarter is likely to be a bit of a reset given what's going on with tariffs. But when you look out over the next several quarters, solid economic growth, solid earnings is a good recipe for compounding wealth in the equity market.
All right, I want to go back to the bond market. Joanna, we're going to get into your wheelhouse right here. Again, I want to go back to BlackRock's Rick Reeder. Came out with a note yesterday. He said in part he's neutral on high-yield bonds, corporate bonds right now. but says basically that Europe is attractive when we're looking at high yield bonds, and the total income makes it more attractive than investment grade. Do you agree with that take?
Yeah, so we agree broadly with both comments that the economy is strong. We believe in the American corporate balance sheet right now. Corporations are starting from a very strong place, and they're going to defend their balance sheet. So even if their growth decelerates, it doesn't mean there's anything wrong with their creditworthiness. So from a bond perspective, American companies are very well capitalized. You will probably see more equity volatility in the future, but there's a lot of opportunity to invest in credit. In fact, if you look over the next 2 years, only 6% of high-yield corporate issuers have to refinance. So they can weather any of this volatility. They can weather this storm. You should be reaching for these yields, these high yields. We love XBB because it's yielding at 6.7% right now, and we don't see a reason not to. But there's
levels to this, it sounds like. There's levels, because before you've come on and talked to us about XCCC, which is CCC rated high-yield corporate bonds, it seems a little risky if you're going to go all the way to CCC. Do you agree with that, or do you think BBB is a little safer, or is CCC okay to dive into? I'm looking, that's like a 10% yield.
It's over 10% yield. It's weathered, a lot of economic uncertainty since 2022. If you look down the road and we kind of normalize it a little bit, why would you jump into the deep end of S&P 500, which has a similar low volatility profile, and not just wade into something like CCC, which has lower vol and has an income like that at 11%? It's hard for people to sort of realize how much risk they're taking on when they're looking at re-upping their equity risk without paying attention to how bonds are structurally different than they were in 2022, post-GFC. Okay. It's a good place to look at.
But just to be clear, you're saying XBB over XCCC right now?
We think XBB is a great value.
Okay.
It's one rung down from investment grade. It's yielding over 6%. And if you reach for those yields, and like I said, we really believe in the corporation's ability to defend their balance sheets, they will slow down hiring. They will reduce costs before they won't pay that coupon.